disaggregate, data aggregate. This is the Issues Watch podcast. Hello and welcome to the Issues Watch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm an assurance principal at Clifton Larson Allen. And back with me today is Frank, an emeritus partner at Witham and my co-presenter for the Society's Law and Ethics webinar. Welcome back, Frank.
Glad to be here, Brad.
Okay.
It's going to be exciting today.
Oh, exciting, yes. Quick disclaimer, the views and statements expressed herein are our own and not necessarily those of NJCPA, CLA, or Witham. All right, so they heard me at the beginning talk about something disaggregate.
Yeah.
Disaggregated. That it's been a very hot topic. Before we go into some of the details of it, let me just go into a definition of it, okay?
Yeah.
Disaggregated data. Disaggregated data refers to data that has been broken down into smaller, more specific categories or groups. This can be done by segregating data based on different variables such as age, gender, race, income, location, or any other relevant factor. Disaggregated data is often used to identify patterns, trends within a larger data set, and can be helpful in identifying disparities or inequities that may not be apparent when looking at the data as a whole. So the source of this, because I couldn't find the definition, real good definition from the AICPA or the FASB, which I would like because there are lords, they should tell us.
Usually in the
right?
front of the
Right.
code.
And I mean like the old English lords, nothing, that guy, yeah, but usually in the front. I picked up on what you just said about that, okay? Yeah, zero. This is from UNICEF.
Yes.
But it's take out some of the stuff that might be in there, but also that could be used too. If you're doing an EBP plan and you start looking at some of that data, some of the data may work. But it's taking the population and breaking it down into different common elements.
Right. It's the opposite of aggregating. It's disaggregating. It's separating.
It's separating.
Yes.
It's like, you see how big I can go? It's separating.
And why do you think they do that?
I don't know why.
I'll tell you why.
Okay.
More information for the user. Again, they want more transparency, so they want users to really dig in to understand how the entity's operating, how it's recording its transactions, and what's important to the entity. So they want us now in a lot of areas to give more information so the user has that information to make the proper decisions about the entity.
But you know, it's weird. You're saying now, and I agree with you.
Right.
With the stuff that's been coming out lately, it's like the waves have gotten bigger and hitting us. This is not new. FAS 14 in 1976 came out and discussed segment data. Okay. And I remember I graduated college in '88 and we started hearing about segment information, but it was public company for the most part. And then FAS 131 came out. I may have said SAS before. FAS 131 came out in 2000, and that further addressed segment reporting. Now, I know you were doing a lot of public company work at that point, and there was a lot of move towards this segment reporting. So now there's examples of where they're moving to. As you said, it's really for the investor and to give them more information. And some of the big ones that I identified that came out is revenue recognition.
Big. Yeah.
I mean, easy one that all companies have to do. I mean, there's so much more for public companies, but all companies have to do is you have to separate your revenue between overtime recognition and point-in-time recognition.
Yes, that's one of the issues.
One
of the items.
Very simple. I see how many people is now. I know a lot. We have supermarkets as clients. They're all point-in-time. Right. But if you have both elements or both methods, you have to break it out somewhere.
Yes.
So, the other CECL, current expected credit losses. I literally just received a message today from somebody in my office asking if anybody has disclosure example to break down the CECL information, the data. Right. Now, I don't know if by your place, if you've seen any, most of the CECL adoption that I've seen has been immaterial, but this woman in my office had a material situation, so she has to break out the data. They're going to start leaning towards breaking out the aging. Why? Yeah. Because you want the readers of financial statements to know how much are they aging their receivables. Sure. They say they have no bad debts, but they have a lot over 120.
Right. And we know they're going to pay. How do you know?
How do you know?
How do you know they're going to pay?
Yeah,
and I think the user wants to see that hey, this company has a lot of sales in the last quarter and it takes 6 months to collect it. They're not getting that money until July.
Yep.
So that's important. It might change the fluctuation in the stock prices for public companies, but also for private companies as well. They might have to go out and borrow to kind of get them over that short-term period. So a lot of factors that are there that take into consideration.
We've spoken about some of these others in past discussions, and somebody at the convention, she was a great presenter. I know you were in her second section on QMS, but she talked about this. The taxes, they're going to require tax disclosed as it relates to federal, state, foreign provision. Your provision has to be broken down between the different components. The states, if it's more than a certain percent, you have to break down the states even further. Then they want the payments broken down, federal, state, foreign, and the states, if you have a significant amount to a particular state, broken down further. The reconciling items, they want more detail as to reconciling items between book and tax. And then the other thing that the FASB has been talking about a lot before we get to ISCPA, we talked about this even last year, disaggregation of the expenses on the income statement.
Yes.
Disclosures, the amount of inventory manufacturing expense, employee compensation, depreciation. Now, you know private companies don't want certain employee compensation.
No, not at all. They don't want that the owner makes $2 million and the employees are making $10,000 each. That's not a good thing.
Yeah, in a private company, you don't want to say what the owner's compensation is. Last one I'll talk about, and then we'll kind of jump into ISCPA stuff relating to this, is the amount of selling expense and the entity's description of selling expense. Now, for years, we've been breaking out advertising expense. I don't know what they're going to do with that, but what are we now considering selling expense? And the recommendation gets into a little bit more, but I listened to a FASB meeting, and unfortunately for practitioners and for people preparing financial statements, I don't feel a lot of pushback on this one. So if you're not happy about this detail that they're going to be looking for, when the meeting I was listening to, there was not a lot of pushback and people saying, this is stupid, let's not do it. So I anticipate this is going to be coming through.
Oh yeah, I think that was put on hold for the breakout on some of the P&L, breaking that out. But I think, again, it's the same theme I think I've had on all these sessions with you. It's more transparency to the user. They want the user to really understand what's happening in the financial statements. And when you talk about, like you mentioned about the owner's compensation, it's not just the employees, I think that matters too. It's the bankers that are giving the loans. And how much is the owner taking as his compensation? Maybe he's taking too much. Maybe he can pay us back the loan quicker. So that's kind of something that they'd want to know.
Oh, I have a client that's looking for a loan, and the banks are telling them no because they're not making any money. And I told the banker, I said, you don't seem to understand. They're cash basis, and they draw down their income to almost zero by paying bonuses and benefit plan contributions. But all right, so watching time. So we're at the AICPA concepts and analytics. This relates to now. I mean, for analytics, I just do this year, last year's. I could.
Oh yeah, that sounds fine.
Super, right? Yeah, you really get a lot of details.
Yeah, you get a lot
because
of
if
details.
last year's wrong and it's comparable, most people say it's comparable.
Right.
Even though last year was wrong.
Or there was an anomaly last year.
Right.
So you have a big expense last year that you're not going to have in the future. You know that. But if the number comes in the same as last year, well, there must be a mistake here. It shouldn't have been as high as last year. So yeah, I really don't like the one. Even if you're going to compare year to year, at least have 3 or 4 or 5 years, because you need to see the trend on where things are flowing. That's a big one for me.
So of course we're being sarcastic. This year, last year is absolutely the worst.
Absolutely
You shouldn't do that. You can go disaggregating analytics. The simple one is month-by-month sales. I don't know how many clients I'm still looking at on QuickBooks. I know I can go into QuickBooks and just do month-by-month sales. And month-by-month sales last year, and boom, I've now disaggregated revenue. Now it's very simple, not real deep, but at least it's something.
Right.
And you can see a trend of the
Absolutely.
months. How come all of a sudden December sales go up immediately? And they're not a holiday store. Oh, are they just trying to push everything into December?
And all expenses. I mean, I had a client that I knew they bought a Prius. This is years ago when a Prius came out. The owner wanted one. The guy was making $1 million a year, but he bought a Prius. And I knew it. I saw it in the parking lot. We go into the office, and we're looking at the P&L for the year. And I said to the set person, find where the Prius is. He goes, how do you know it's not? I said, I don't see it in fixed assets. So they're looking. They didn't know where to look. I said, well, let's look at auto expense. And we saw auto expense was like, 20, 20, 20, 50, 20, 20, 20. I said, I bet you it's in there. He said, how do you know that? I said, look at the trend. And sure enough, went in there and we found out they were trying to expense it.
Well, it's auto expense. You shouldn't have a lot of gas. So why would it jump up so much?
See, that's a great comment you just said. Because if they're using electronic vehicles, you would not expect to see auto gas expense to go up. It should be going down.
Right. So a couple other ones I'm going to hit on quick because we're getting to the wrap-up point. Going even deeper, sales, cost of sales, and gross profit by product. I have a franchise, and what we do, the data mining, we go in and we go by product, and we analyze the sales by month, by product. And we're talking hundreds of thousands of rows, but the software now lets us analyze it. So we busted it apart completely, disaggregated it by item, and then re-aggregated by area, but it's still not total
With
sales.
technology today, we should be able to break any of this down. Like some of the other items are by region or geographic location. That's important. It's important for the user because what if there's like fires out in the Midwest or in the West, and your company sells a lot of sales to the West Coast? That might impact the user's understanding of the financial and what's going to happen in the future. So this stuff has to be done, and it's good information.
Yep. Compare the average price of a unit or that you sell it for, or what the industry sells it for, to your sales price for your individual units, and looking for anomalies. Breaking out this information in more detail.
Your competition might not like that. Or the competition would like to get that information. You don't want that information going to your competition.
Oh no, I'm not putting that in the report. I'm putting that in my audit footnotes.
Oh, okay.
Yeah, and if you have other clients in a similar industry, you should be not sharing data, confidentiality. We're going to talk about. We're going to be doing an ethics session. You don't want to talk anything confidentiality, but you should use that information in your head.
Agreed.
So, all right, that's it on disaggregated information. In closing, here's some upcoming accounting and auditing events. On July 17th, the Society is holding its annual Governmental Accounting and Auditing Conference. And you can earn up to 24 A&A credits at the Atlantic City CPE Cluster, taking place August 12th to the 14th at the Tropicana Casino and Resort. Get info for these events and more at njcpa.org/events. And of course, be sure to join the Society's Accounting and Auditing Standards Interest Group. Sign up for free at njcpa.org/group. Frank, thanks for joining me, man.
Always happy to be here, Brad.
I'm so glad we did analytics because not disaggregate stuff because that. Yep. Thank you for watching or listening.